All right, let's talk about something that's probably on a lot of our minds, planning for long-term care. It's a huge financial hurdle, right? But what if I told you there's a powerful tool, one that's often missed, baked right into the tax code to help you out? Well, there is. And today, we're going to crack open the brand new inflation-adjusted numbers for long-term care insurance deductions for the 2026 tax year. This is good stuff.
Okay, so here's our game plan. First, we'll tackle the problem head-on, the crazy cost of care. Then, we'll get into the solution, the tax code's incentive. After that, we'll dive into the juicy part, the new 2026 deduction limits. We'll also need to figure out what qualified actually means for a policy. And finally, we'll see how all this applies to you, depending on your tax situation. Let's get to it.
So first things first, let's set the stage here. To really get why this tax deduction is such a big deal, you first have to understand the size of the financial mountain we're talking about. It's pretty staggering. Okay, take a deep breath and look at this number. $108,000. And let's be super clear, that's not for a lifetime of care. That's the annual median cost for 1 year in a semi-private room. I mean, wow. A number like that can absolutely blow up a retirement plan you've spent your entire life building. It's a serious threat. So, here's the bottom line. If you don't have a plan in place for this, the financial risk is it's huge. We're not talking about a small bump in the road. We're talking about a potential financial wrecking ball for your family's savings. And that right there is exactly why the government stepped in with the tax code to try and help.
So, what's the government's answer to this giant problem? Well, it's not some complicated program. It's a pretty direct and targeted solution written right into our tax laws. You know, the IRS is basically sending a clear message, hey, if you plan ahead for this, we'll give you a tax break for your trouble. It's an incentive, plain and simple.
And you know, this whole tax break didn't just pop up overnight. Let's rewind the clock a bit to 1996, to a piece of legislation you've probably heard of, HIPAA. This was a really intentional move by lawmakers. The thinking was, how can we encourage people to get private insurance for long-term care? The goal was to ease the pressure on public programs down the road, like Medicaid. And the mechanism they came up with was creating this special, tax-favored type of policy. And that brings us to the key phrase you absolutely need to know: qualified long-term care insurance, or QLTCI for short. Think of it this way. The IRS created a special club, and if your policy is in it, it gets treated just like regular health insurance for tax purposes. And that is the golden ticket that makes your premiums potentially deductible. Okay, here we go. This is the moment you've been waiting for. Let's get into the nitty-gritty. The brand new, just released, inflation-adjusted deduction limits for 2026. The big question is, how much can you actually write off? Well, it all comes down to one thing: how old you are. So let's break this chart down. What you're seeing here are the maximum amounts you can count as a medical expense based on your age. Look at the column for 2026. See that pattern? As you get older, the amount you can deduct goes up and up and up. It makes sense, right? The government is basically saying, we know your risk goes up with age, and your premiums probably will too, so we're going to let your potential tax break grow right along with it. But now, check this out. Look at the jump between the 51 to 60 bracket and the 61 to 70 bracket. Whoa, it skyrockets by 166%. That is not a typo, and it's definitely not an accident. Think about it. The tax code is creating what you could call a critical retention zone. It's giving you this huge financial reason to hang on to your policy right as you're heading into retirement, which of course is when you're most likely to actually need it. Pretty smart, huh?
And this gets even better. I like to call this the longevity lever. Once you're 71 or older, this tax benefit gets seriously powerful. Just imagine a married couple, right? If they both have policies, they could potentially count up to a combined $12,400 in premiums in 2026. That is a huge help when it comes to covering the higher costs of insurance later in life.
Okay, so we've seen the numbers, and they look pretty good. But now you're probably asking, what exactly makes a policy qualified in the first place? I mean, is it just something the insurance company slaps on the brochure? Nope. It's a very strict legal definition, straight from the Internal Revenue Code, Section 772. For a policy to get that special qualified stamp of approval, it has to check a bunch of very specific boxes. Think of these as the non-negotiable rules. For instance, it has to be guaranteed renewable, which is huge. It means the insurance company can't just decide to drop you. Another big one, it can't have a cash surrender value, so it's not a savings account. All these rules are there for one reason: to make sure the policy is doing what it's supposed to do.
paying for long-term care, and to protect you, the consumer.
Another really important piece of this puzzle is what actually triggers the benefits. I mean, when does the policy start paying? Well, with a qualified policy, the switch gets flipped only when a doctor or another licensed pro certifies that you're chronically ill, and that has a specific legal meaning. It means you can't perform at least 2 of the 6 basic activities of daily living, things like eating, bathing, dressing, or you have a severe cognitive issue like dementia or Alzheimer's and need someone to keep you safe.
Okay, let's talk about something that trips a lot of people up, those popular hybrid policies, the ones that mix life insurance with long-term care. You have to be really careful here. The rule is crystal clear. The money you pay for the basic life insurance part, that's not deductible. End of story. The only part that's potentially deductible is the specific extra amount you're charged for the long-term care benefits. The law calls it a separately identifiable charge. You got to know which part is which.
All right, so we've got the numbers, we know what qualified means, so how does this actually work when you sit down to do your taxes? This is where it gets really interesting, because how you take this deduction changes dramatically depending on whether you work for someone else or for yourself.
Okay, first up, let's talk about folks who get a W-2 or are retired and itemize their deductions. For you, these qualified premiums get lumped in with all your other medical expenses on Schedule A. But, and this is a big but, there's a catch. You can only deduct the portion of your total medical costs that goes above 7.5% of your adjusted gross income, your AGI. And honestly, for a lot of people, that's a pretty high hurdle to jump over.
But if you're self-employed, this is a total game changer. For you, this isn't a medical expense on Schedule A, it's an above-the-line deduction. What does that mean? It means it comes right off the top, directly lowering your adjusted gross income. You don't have to worry about that 7.5% AGI threshold at all. It's a first-dollar benefit, which makes it so much more powerful and easier to claim. This is a huge perk of being your own boss.
And hey, you don't have to take my word for it. Listen to Jesse Sloan, who's with the American Association for Long-Term Care Insurance. He says it flat out, business owners are really the ones who can get the absolute most out of this deduction.
And it can get even better. If you're a C-Corp owner, you might have hit the tax deduction jackpot. For C corporations, the rules are often the most generous. The company can usually deduct 100% of the premium it pays for you as a business expense. And, get this, it doesn't count as taxable income to you. It's a win-win.
So when you put it all together, the big takeaway is this. The tax code gives us a really clear, really structured, and frankly, a more and more generous reason to plan for long-term care. It's not just a good idea, it's a tax-smart one. So the real question I'll leave you with is this. Now that you know the new 2026 rules, is your plan as tax efficient as it could possibly be? It's probably a great time to have that conversation with your financial advisor or your tax